So pumped for 2024, ladies and gentlemen. Welcome back to the channel. Yes, 2023 came to an end. Today, we're going to be diving into a topic that's on everyone's mind, the financial landscape of 2024 and how it stacks up against the whirlwind year of 2023. It's not every day that we see a significant shift, and we're here to unpack it all on the Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis. First step, we're going to be looking at the state of the financial system. So what's changed since last year? What stayed the same? We'll break it down in a way that's easy to understand, no matter your level of financial expertise. We're going to also dive into the big charts, like the yearly charts. We're going to look at the sectors. You can download this chart deck if you want to revisit them, so you don't need to manually pull up yearly charts, okay? But of course, we can't forget the details. We're also going to zoom in on the micro charts to see an intricate workings of the markets. It's in these small details where we often find the surprising insights and the changes quickly in the trend. And lastly, we're also going to look into some various stock market indicators and signals and see what that's telling us as we head into the start of this new year. So get comfy, grab your notepad, and let's dive into the show. Welcome back, everybody. We're going to start off here. Take a look at the Qs. It was up 53%, and the sector right above that was XLK, the tech sector, almost 50%. Now, that is a very, very strong year in the Nasdaq 100. Because if you look back to the left of the screen, we haven't seen a year like that really since, well, it was actually higher than this year over here, and that was in 2009 after the great financial crisis. We haven't seen this since 1999, and we all knew what happened then. So a lot of people have been saying we haven't seen a move like this since 1999. Well, I mean, it was pretty much the same move since the bottom of the financial crisis. So, what's the difference between these two? Well, I looked into it. You can see the percent of the S&P 500 members with 100% annual gains by the year differ greatly from 2009 and, 2023. In 23, it was clearly led 2.4% of the stocks had 100% gain. So it was led by very few stocks, and those were the larger market cap names. In 2009, 9% of the S&P 500 actually had 100% gains. 9% of the stocks in the S&P 500 had those annual percent gains there within. If we take a look at this chart, the percent of stocks underperforming the S&P 500, the year 2023, we saw a pretty significant shot up. So clearly, very few names in the market is what really drove this thing higher. Is that bad? Is that good? Well, we'll discuss it in today's show and what assets are most important to be paying attention to as we head, obviously, into this wonderful new year. Now, if we take a look at the market view where we have a bunch of different assets over here, you have year-to-date performance. You can see BITO at the top. So Bitcoin did very well. I think it was up 150% or so. Then you have tech stocks, right? So tech led the way, and go figure, because the S&P 500, which we just previously discussed, the largest market cap names are, tech stocks for the most part, right? And if we look down the list, well, what finished in the red? Okay, well, we had the 10-year yield, TLT, which is bonds, and we had the dollar. And then beyond that, we had some consumer staples, utilities, we had regional banks, which we had all kinds of crazy stuff happen then. But what I want to call out is when you go month to date, look at all this green here too as well. So the month of December, but what was in the red? Well, 10-year yield was in the red, the dollar was in the red. Let's go even to the micro. Over here, the percent change on the last day of the year, everything was in the red, but what was actually in the green? The 10-year yield and the dollar. These two assets have been tremendously important to pay attention to from an intermarket perspective, and they're going to continue to be an important asset to watch going into 2024. Now, if we take a look at the year performance on a daily basis, so every candle on this chart represents a day for the S&P 500, we closed at around the high. And we opened right here, right around the low. Right? So we basically opened up, and there was some volatility. We had two corrections, just about right, two 10% corrections, and we closed at the high. So we start at the low, we close at the high. So overall, an easy year. And what's the difference between this year and the year prior, which will show the yearly candles. But what I'm noticing as far as sentiment goes, people are celebrating their P&L for this at a much more greater detail, but they didn't the prior year. And we haven't even reached back to the all-time high yet. So it was a good year. Congratulations if you made money. If you didn't, it was actually more difficult of a trading year if you look at underlying assets that did not perform. Like the IWM, for example, it took a while for that, like the very last bit of the year, for it to actually really start cranking up, which I think the IWM finished slightly there in the green. Yes, because of the very last trailing months of the year. Now, I anchored a VWAP into this area, and this area is going to be an important one to obviously watch. We had that 10% correction over here in the S&P 500, right at around 410. And what's crazy to me is we opened up, January 2023, right in this range. We came up, we came back down, right? So not much movement to start the year. We came up, and remember this choppy range where we just got thrown back and forth. We talked about, gamma building up over here, all this open interest to see an explosive move. And when we finally broke from that, we saw that explosive move that led to what? It led to another correction to test back into this area. Okay, so where can a potential pullback take place? Because this type of move, which we have not seen this type of move for a very long time. I think it was 2004, which is the last time that we saw, I think it was 9 weeks or 7 or 9 weeks, I forget the exact number, up in the green. So this isn't typical market behavior. And this leads me to believe that the 2024 performance this year, going into 2024, I think it's going to be an underperforming year versus 2023, because it's very rare to have something like a back-to-back 50% up type of year, okay? That's just what history tells us. Okay, so where can you potentially look for pullbacks? Well, we had an explosive move here from the whole Fed pivot situation. Take a look at the anchored VWAP. It comes up. It's moving up. We haven't even tested it. So if price were to break through and pull back, this could be a very important level of interest to be paying attention to. It doesn't mean you buy at it, but if you see strength after it touches, that could be a very potential opportunity. Okay, what can potentially drive the markets higher? I'm trying to think here, because there is a lot of poor economic data, but there's also this, and this is the money market funds. Okay, so the flow into the money market funds, and what you'll see here is we're seeing just a rapid rise here. So if money is going to travel outside of the money markets and back into the overall stock markets, that could be something that helps propel us further in 2024. Now, we talked about the 10-year yield in the dollar. I want to revisit this chart. You can see when the 10-year yield goes up and the dollar goes up, the green lines are showing what happened to the S&P 500. Well, that was when we saw that 10% correction. Then we saw this extremely blast off a type move. And this extremely blast off type move is coming on the heels of a potential pivot and rates being cut, which we'll discuss more. But the 10-year yield dropped, the dollar dropped. What did the S&P 500 do? It completely rallied, which leads me to believe that if the dollar were to all of a sudden catch more of a bid and start moving itself back up, maybe even it drops to 100 and tests it, but comes up further, and the 10-year yield starts to level out or potentially even rise, that could potentially not be good for the overall markets. Now, if we take a look at the yield curve, this is the best predictor of a recession to come in the future. Well, what you'll notice here is we're still incredibly deeply inverted. Okay, over 150 basis points inverted on the 10-year minus 3-month yield curve. So we had the 2020 recession. We came out of it. Okay. Great financial crisis. We had a yield curve inverted. We uninverted. We went into the crisis, right? The dot-com bubble, the 1990 recession, and so forth. So this is a lot larger scale as far as an inversion goes. But we really don't see problems until the yield curve uninverts. So one of the charts that I show very frequently, that the yield curve, this is the yield curve, by the way, yield curve, this is the 10-year and 2-year, and you'll see it uninverts, it starts to steepen greatly, and that's when you see that market volatility steepens greatly. You see that market volatility right here. We had a little yield curve inversion, boom, we saw that volatility over here, and that was, you can call that from the pandemic, but we did get these warning signs. And well, we're here, but we haven't really started to steeply uninvert. Now, it's not about predicting what the market's going to do, but it's at least to prepare us for what may happen in the future. And if we see the likelihood of another potential credit type crunch or credit crisis, we're seeing all the signs, right? So if the signs are here, you can't tell me you're shocked that something big happens, right? You just got to be prepared, both financially and mentally, for if it were to take place. Now, the Fed rate hike, or the federal funds effective rate, which is down here, you'll see that during the rate increases. So when we're increasing rates, moving them up, right? That's typically, it leads people to save money, right? And then when it's down near zero, it encourages people to spend money. Why? Because money's cheap. It's flowing everywhere. And that's when you typically see the markets really start to rise. And you can see that in a lot of interesting type setups like retail names and so forth. But you'll see here, as we uninverted, the rate went down. As we uninverted, right, the rates went down. And now the market is now pricing in. This is from Goldman Sachs. They're saying that we expect the FOMC to deliver 3 consecutive cuts in March, May, and June before slowing to a quarterly pace in Q3 and Q4. There's also news out that the Federal Reserve sees 3 rate cuts in 2024, but the market is betting on 6 rate cuts. So what does the market see, that the Fed doesn't right now? So is something going to potentially break for them to say, hey, we got to move rates back down quick? Because the narrative has been, we got to hold rates higher for longer to fight inflation. But that really changed on the last Fed meeting. So right now, the markets are in the Fed hands. The Fed, what they say will have a much more dramatic impact on the markets than it has in prior trading sessions because of what the market has been doing these last 7 to 9 weeks. Now, I also want to go into some important macro type charts to give you an idea of what the environment is going into 2024. Okay, this isn't just a narrative. This is just me showing you data. All right, this is loans and leases and bank credit. Right, when money's flowing, banks are lending out money. Right, but if it's contracting year over year perspective, it's going down. That's credit growth contraction. And what do we see going on right now? Well, let me draw it out. We're seeing this go down. We've been talking about this since the turn. Okay, since the turn. And what do you notice back going to the left of the screen? Well, you'll see gray shaded areas, and the gray shaded areas are where recessions took place. You will not see a recession where we're currently at right now. But what you'll notice is as the credit growth or loans and leases and bank credit year over year contracts, you'll see that happens preceding to every recession. Now, it doesn't mean that when we get credit growth retraction, there has to be a recession, but every recession prior to it and into it, you see credit growth contracting. Okay? Simple way to look at it. But what is another layer that we can add to this? What is the similarity between the great financial crisis, the dot-com bubble, 1990, and so forth? Well, take a look at the yield curve. So this is the same chart looking back to 1988. The red line, however, I added. The red line is the 10-year minus 2-year yield curve. When it is below the 0 line, that's the yield curve that's uninverted or inverted, right? Red, 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 and we go back over here. It's red, red, red. It was a really tiny red over here, right, in the 2020, which we discussed. Even back here into the 80s, it was inverted. Now, what do you notice with the loans and leases and bank credit? You'll see as the yield curve uninverts, while this is already heading down, right? Credit growth is contracting, yield curve's inverted. When they start closing those jaws together, that's when we have recessions. You got the the steepening, right? Boom. And then credit growth is contracting, gray line. We got the recession. Steepened, boom. Credit growth has been contracting, gray line. Boom, steepening. Credit growth is contracting, gray shaded area. All right. Even right here, we had this very small little tiny yield curve inversion and it was pointing down here, right? And then the Fed stepped in almost immediately. That's a whole different situation with the pandemic. Okay. Understandably, but take a look where we're at now. Boom, we're inverted. Okay. So at what point are we going to invert? This is not good to have an inverted yield curve by any means. This is where things break. This is every single time that we've had an inverted yield curve, something has broken not too long after, right? 12 months, 18 months, whatever the case may be. Maybe we can hold it off for longer. Maybe they got new tools, but it's not a good place to be from an economic standpoint. So credit growth is contracting, boom, 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 boom. Yield curve is going to eventually have to invert at some point. So what is going to happen? Chances are, history tells us that we'll be walking into another sort of event or some sort of recession. Now, timing this is obviously going to be a very difficult thing. That's why we don't really time these type of large events. It's where you really prepare, and there's multiple ways to prepare, but we're going to keep on going on and looking at some other stuff. So this is the federal funds effective rate, the blue line, and then we have the 10-year, 2-year yield curve. You'll notice that every time that we're leading into recession, where the yield curve is starting to steepen, that is during where the Fed is going to start cutting rates, which we priorly discussed, cutting rates. And now we're already talking about cutting rates here too as well, okay, as the yield curve is currently inverted. So if we continue on, this chart is showing us the 2-year yield curve in red, and the blue line is the federal funds effective rate. And what you'll notice here, dating back to this 2000 range, when the 2-year yield goes below the federal funds effective rate after a rate hiking cycle, it typically is giving us the heads up notice that while it heads down, the federal funds effective rate, the Fed is going to start lowering rates shortly thereafter. So you see the cross here. Shortly thereafter, well, kind of shortly thereafter, right? They held it for a while. It started reducing rates. And then you can see right here, boom, we crossed down over here. And shortly thereafter, we started reducing rates there too as well. Well, over here, we started crossing back under where the federal funds rate. Now we're already talking about rate cuts, and this is starting to head down here itself. And you'll notice that every time that this is taking place, not too far after, we also had recessions as well. Okay. If we continue on, take a look at something like this, where this is the net percentage of domestic banks that are reporting strong demand for commercial and industrial loans from both small and large and medium firms. Okay. So is there a strong demand for commercial loans or industrial loans? Right? If there was a strong demand, that would tell us that there's a lot of growth taking place in the markets, not the financial markets, but maybe the economy overall. But what you'll notice here is we're actually at a pretty depleted level, to levels that we haven't really seen since coming out of the 2020 area until we had a limited QE hit. But then also we're at around a level that happened in 2008, and also the dot-com bust there too as well. Let's look at the flip side of that. Well, what about the tightening standards for commercial and industrial loans? So are banks willing, or are they tightening up? Right? Well, yeah, the flip side of that is yes. We haven't seen this since coming around 2020. Right? 2008 and the dot-com bubble there too as well. Now, we already know that if we look at the Fed balance sheet, total assets, we have been tightening, right? So the market, so the Fed is tightening still as it stands. However, there's still a lot of sloshes of liquidity. The word's being thrown around a lot, and there's a lot of different charts and a lot of different tools that they're using. So we're not going to get too in depth with all of that. Okay, but what we'll point out here is the reserve balances for Federal Reserve banks, right? So other factors draining. So just think of this in terms of liquidity. We've showed this multiple different times. So liabilities and capital, other factors draining reserve balances, that's in blue. And then the red line is the S&P 500. And what you'll notice is as this has been draining, boom, heading down, that's when we saw a lot of volatility in 2022. Now, this doesn't line up perfectly if you date way back, but it has been working out quite good pretty recently. So over here in 2023, which we basically started, this is what gets interesting. We started 2023 in the S&P 500, right? And that was pretty much the low of the day, or the low of the year, right? The start of the year. And then over here, this was pretty much the low of the year too as well. Okay. And then we shot up, boom. This right over here, this marks right where about SVB blew up, I believe. Okay. And the market was pulling down. And then guess what? We saw this big injection, boom. And then the market started rallying up, just loving it, okay? But there's other factors of that too as well. But what was going on here with the other factors draining reserve balances with the liquidity? Well, it wasn't actually really matching that. And then the market had that 10% correction. Until recently, we saw that boom move higher, and the market moved higher. Now what we're seeing is actually starting to pull back down, and the market has not done that yet. So what else helped drive this move over here after the Silicon Valley Bank explosion? Well, the Bank Term Funding Program. The Bank Term Funding Program started right over here, okay, where the market pulled down, boom, it kicked in, and guess what? The market just went on a monster tear. So call this not QE. I mean, I don't understand the intricacies of the Bank Term Funding Program, but I don't need to. I can just look at this chart and say, wow, when they kicked in, when this program came in, the S&P 500 rallied, and then guess what? It started to flatten out over here, and the market started to correct. And up until recently, we're starting to see it being utilized again, and the market's really starting to rip there too as well. So that's the state of the current view of what we're doing, or what the look is going into 2024. But the price action doesn't really match kind of the negative look of all this stuff. So we're going to hop into some yearly candles. All right, so we're going to look at some of the yearly charts on the index products and some other stuff. To keep this show a little bit shorter, I'm not going to go through all of them. I'll just say if you download the deck, there is a lot of different yearly charts from an intermarket perspective, from a commodities perspective, from a sector's perspective, and it'll just allow you to visually see. Now, as we move into this, I want you to pay attention to just how the candles are structured, just to give you an idea. And despite seeing a big year, which we priorly discussed, S&P 500 finished up 24%, right? And a lot of that came from the last few months. That was actually lower than the prior year's high, and it was above the prior year's low. So this is actually just an inside trading candle. And we had a big year, big year, big year. So we're seeing a lot of volatility in the markets. So what makes us think that volatility is really going to go away in the S&P 500? Well, there has been no proof of that. We're seeing just large range candles, authoritative moves. So are we going to see some follow through? Potentially get through that 4,800. Okay, but right as it stands, these are inside candles. So remember, markets move between expansion and contraction, and this would be considered a period of contraction. It's just a large range of contraction, to say the least, on these yearly charts. Now, the NDX shows a different story. That was an explosive year, right? We started around the low of the year. We didn't break this prior low, and we moved basically straight up to touch and to close around the 17,000 marker of the high, and that was above the prior trading year. So as it stands, 53% up on the year. This is why I say 2024 will probably underperform 2023, right? It's very rare to see this large, huge move, 2 years back to back, but we will see. We got to be open-minded at the least, okay? If we take a look at the INDU, the Dow Jones Industrial Average also kind of came out of this pattern over here, right? We had a high, prior high, and you can see as we close, we broke out of that and we closed above the prior high and the prior high year after that. So this has been in a pretty steady uptrend there itself. Okay, if we keep on continuing on IWM, it's an inside trading candle here too as well, right? A period of digestion after a strong move to the downside. Okay, so the market is currently digesting in a lot of different aspects. Look at the Nasdaq composite. This is a much broader market. This was also, right, up 43% on the year, but we're trading within the prior year's candle. All right, so to celebrate anything right now, it's really not. This is like, if you think of this from a fractal perspective and you have a day, that was, down like this, and then you had, a nice up day, and it was just an inside day. Like, are you getting that excited? And not really. I mean, now, if you manage to manage your money thoroughly through here, and then you catch, the price action throughout here, where you didn't take this huge drawdown in 2022, then yeah, that's something to be excited about. Look at the NYSE inside trading candle here too as well. Okay, take a look at EEM inside trading candle. Hong Kong stock market index will go global. This stuff has been getting completely and utterly obliterated. Right in 2022, we saw a big bounce from the bottom, but it was a huge range candle. Today, or this year, it was an inside trading year there too as well. Take a look at Japan. Japan actually saw an explosive move, right? So look at this. This was an inside trading year, right? Contraction, right? The market's contracting, and we got above the high of the year. We saw this explosive move out of it. So Japan's looking pretty darn strong overall. So if we get a pullback, maybe look at the prior year, right? Around 280, pullback, boom. Maybe we see some continued follow through right there, right? Like we had a pretty decent year there. Huge follow through, and we had that follow through there too as well. Okay, Japan's small caps. So if Japan's going to do well, maybe small caps will perform too. And what you'll notice here is you're seeing the market kind of just going sideways for many years, right? Dating back to 2017. We had a lot of volatility, obviously, in 2020. We tried to break out from in 2021, right? But we came right back down, closed around the low. We saw this move, and now we have an inside trading candle. So if Japan is going to continue some strength, maybe small caps from Japan might be an opportunity here as we're just in this inside trading candle. So what you'd want to look for is break above the prior year high, and maybe, hey, we go try to take a shot even higher. That's always a possibility. Look at the France stock market index, CAC, the CAC. This closed, another high right over here. It's in multiple years. It could be an all-time high. The DAX, the same thing, started really moving up. So the markets overall look pretty good. And BVS, so Brazil stock market, like this was a gigantic move right here, right? A lot of volatility. We contracted, smaller bodies, and then we saw this explosive move. So these are good looking charts. Overall, it'd be hard to think that anything bad can potentially happen, but these are the type of charts you want to pay close attention to, because if we get follow through, you want to be able to catch those type of moves. Even India also looks very strong, right? These are yearly candles, mind you, and when volatility strikes, it can strike and it can strike hard. You can see this large lower wick in 2020, right? You just saw it all the way back down, right? But the last 3 years, right? I mean, in 2021, we close here and we're, above it nicely over here a couple years later. So this could be one if we're going to want to continue to see pullbacks and potentially buy it as it stands. But at the moment, right, a lot of things are closing at their highs from this recent rally. Let's quickly take a look at some of the sectors. XLI, right, like industrials, we saw that explosive move, right, from breaking out of this kind of hanging man candle, getting above the high and saw that move. I wanted to call out consumer staples. You're getting some indecision type moves here. Let me fix my screen. In indecision, these type of candles are smaller body. So for the last 2 years, 3 years, right? We closed in 2021 here. We had some volatility in 2022, but we closed at the same level. And basically 2023, we're at the same exact level again. So I think that consumer staples can make a move up, a potential stronger move here in the very next, this coming year, right? This is an inside trading doji candle. This is a period of contraction. Does that mean it's going to break up or down? I do not have that answer, but you can watch the high, you can watch the low, see if we get some follow through on the breakout. Now, healthcare looks pretty good too, right? We had an inside trading candle, but you'll notice we close it around the high there. We have a low, a higher low, a higher low. We have a high and a lower high. So right now it's contracting in these small body candles there too as well. So we closed where? We closed where we were in 2021. So the market's been going sideways amongst this volatility. And this right here could very well be a big point to watch for XLV to break out of. So healthcare could be on the radar. Like I said, we have a lot more in here. Energy sector, take a look at energy sector. We opened at 83.84, and guess where we closed? We closed at 83.84, completely unchanged. This is an insane doji candle. So what I'd say here is, put on the daily chart starting tomorrow when the market opens up, apply a year-to-date anchored VWAP. And if price stays above it, you play it to the upside. But if price goes below it, watch out, because we can have more downside. Okay, and then you watch that year-to-date anchored VWAP. That's all I'm going to show on the year-to-date candles. At this current standpoint, there's even mega caps in here, but just to kind of speed things up and give you an idea of how I look and how I review the candles. Inside candles means they're contracting, so we can see potentially strong moves. Then you see like these indecision candles, meaning that a move could very well be in the near future. So those could be sectors you want to pay attention to. Okay, let's zoom in now, and I like to look close in on the S&P 500, right? The big broad market. Let me see if I can open this up a little bit here. I'm just wondering why I don't know if that's showing or not, or if it looks weird on my screen, but I guess I'll find out after I'm done recording. This is the 30-minute time frame. So this is really zooming in, and I have the new weekly expected moves going into the new year, right? These weekly expected moves. This is what the market is pricing in as far as risk goes going into the following week of trade. And if you think of it as a distribution curve, right, 68% of the times price will close within there. Typically with the S&P 500, it's a bigger product, a lot more volume. This is a large product, so you even have higher rates of like close to 80% of the time closing within the weekly expected moves. And now the daily expected moves, that's a daily basis because they have daily expirations. And then you have the purple line is the 5-day moving average. So if you want these levels, make sure to download the chart deck and put them on your screen. Helps if you're getting a little bit more tactical. The 5-day moving average, it's still inclining. Price closed below it. Okay, when it closes below it, that's where you want to be bearish, but you want to be bearish with caution because it's still inclining. Like right here, we said be bearish, but be bearish with caution. Why? Well, we'll talk about gamma levels here momentarily, but it was still inclining. And guess what? We said we can get it easy. Just because we saw this shots fired, right? On my last episode, we filmed it, right? It was from here. We said just because we saw shots fired here due to zero date, just zero date manipulation, I'd say, on low volume, we can see a zero date snap back, and that's exactly what we saw. The 5-day moving average, like I said, is still inclining, but starting to roll over. This could be a potential bear flag, but I don't read in too much into this as of right now because the 5-day moving average is still inclining. Until it starts rolling itself over, I pay more attention from a risk, a negative risk perspective there from the short side. Now, if we look at gamma levels, now I usually show the gamma levels on this chart on the SPX, but I noticed that they worked a little bit better by applying them on the SPX chart, looking at, see, why is that? Why it shows weird on my screen. So hopefully it shows normal, but this is by Owanda, I think it is. So if you want to pull it up on TradingView, the levels work a little bit cleaner as far as the gamma exposure levels go. So I'll be, viewing it from this perspective, the gamma levels at least. But then when it comes to weekly, daily expected moves, I'll pay attention to the levels on this one. So you can see we had that call wall at 4,800. Price was up in that area and it kept on getting rejected. And then we sold off into these lower levels, these gamma levels that we discussed prior. And this happened to also be by a massive put wall of 0 date on Friday. And we saw that bounce from that level. So that's why you want to pay attention to these gamma exposure levels. It's how, it's market's hedge risk, right? So you can keep paying attention to these levels because you can see big breaks from them. You can see price push away or magnetize towards these certain levels. Now the gamma flip is over here at 47.50. The gamma flip is an important level to pay attention to because as it stands right now, if we're in positive gamma territory, that tells me that buyers or the dealers are looking to buy the dip and sell the rip. Buy the dip, sell the rip, buy the dip, sell the rip, buy the dip, sell the rip. So you get this constant move nicely higher. But when we get below this level, this is where we see some more volatility. And that's where you can see selling into selling, dealers buy into buying, dealers sell into selling. And that's where you can get these extreme moves in the market. So two things when we really go into 2024, if you're going to be swing trading, is you want a rising 5-day moving average from the long side and you want price to be above it. All right. You can wait for price, to start turning back around like this and price goes like this. Boom, you can catch it early and hopefully that's a new uptrend and doesn't turn right back around. Okay. But you also want to be in a positive gamma territory. Both those combined, what I've noticed throughout trading, breakout trading, swing trading, is when you're in a positive gamma territory, which we've been in, and when you're in a rising 5-day moving average perspective, when price is above it and it's inclining, those have presented the best breakouts and moves in various different trades, and that's when you can make and capitalize on some good trades. So as it stands right now, gamma flips at 47.50. Local resistance still at 4,800. This will update and change as we go into the new year. And then local support is at 47.65 as it stands right now. Looking at the SPX on using OA and DA. So it's a little bit different than the SPX chart. You can use either one, to be honest. I used to use it on the SPX chart. I'm just changing it a little bit just to keep them separate. Okay, take a look at the dollar. We'll zoom into the dollar. We talked about how the dollar was an important intermarket asset to watch. And as this has dropped, the S&P 500 rose. And you can see the price is getting pretty beat up here. So you got to think as going into 2023, price was getting pretty beat up in the S&P 500, right? Price was getting pretty beat up. And what do? We bounced. We saw some more volatility. What the heck just happened? There we go. And then we had a nice move. So is 2024 going to be a potential, falling wedge? Price is going to start moving up higher in the dollar? Possibly. But just watch that 99 low over here because that could be a potential level. That's where the prior level of support was, where we start to see the market move higher there in the dollar. Okay, and then the 10-year yield, I'm watching this price momentum oscillator over here, right? The price momentum oscillator, we had that negative divergence we talked about on the RSI and this, right? As the price went higher on the 10-year yield, right? Or the yield went higher, there was a divergence in the indicators. And then we had the bearish crossover, and then the market started to break down. We saw this head and shoulders. We mapped up to target to 40 to 41. It broke down further, but now it's starting to flatten out. So is this telling us when this crosses back over, how it's done multiple times where we see the 10-year yield pop, 10-year yield pop, 10-year yield started moving up higher too, okay? Is the 10-year yield going to pop? And is that going to be what pulls back the market from this euphoric move in the short term and then potentially set it up for higher highs if everything goes swimmingly and the market doesn't care about an inverted yield curve, uninverting and steepening at some point? Okay, let's take a look at the indicators. What are the signal charts telling us? The signal charts are telling us that things are for. There's the COMPQ, right? The Nasdaq composite, right? This thing has been grinding up like an algorithm, moving up higher, getting a pretty high reading. They're at 92.89 on the RSI. That's been a while since we've seen it. The NYSE bullish percent index, same thing, grinding higher right above that 90 marker there too as well. The last times we were here, we saw some pullback. So I think it's very possible to see, so the markets kind of digest a little bit. Now going into the new year, we see a lot of volatility, right? We can see pretty strong moves. So just be aware of that. What I like to do is I apply that year-to-date anchored VWAP. If we're above it, good to go. If we're below it, just watch out and be careful, because it tells us that the average person, based off of volume and time, is underwater or above water, and that changes the psychology of overall market participants. INDU, also bullish percent index, is a negative divergence, and we're getting a high reading, right? 80% of the stocks in the industrial average, in the Dow Jones, the DJIA, is on buy signals, and those are pretty extended readings as we've seen in the past. If you look at the BP NDX, also RSI is pretty frothy there too, as well as the market's been moving up. BPSPX also pretty frothy. Overbought can stay overbought for a while. We say that frequently, and then we like to look for negative, positive divergences, and we're above that 80 marker. And when we get above these 80 markers, when it starts crossing back below the 70 line, that's when we've actually seen the market kind of move into some more volatile times, dating back throughout that, at least 2022 on this specific chart. Look at the summation index, right? When we see this parabolic star undertick the summation index, it can identify a potential change in trend. Well, guess what? It's identified it for sure, and we saw this explosive move. Okay, so if this starts turning back around and we get a parabolic star, that's going to tell us, hey, the potential change in trend is now taking place, right? The negative divergence in the Nasdaq may play out, or it could be a period of consolidation or digestion of this current rally. You look at the NYSE McClellan oscillator, the traditional calculation, this divergence is still building out. So we had a high. We had a lower high over here, as price action pushes higher in this very kind of algorithmic type of chase into that year-end FOMO, Santa Claus, whatever you want to call it, type of rally. So it's going to be very important, as we've seen the market move with very shallow pullbacks. We haven't seen a period of digestion or a proper pullback to know if this is going to be a sustainable rally. And the last one I'll close off here was the summation index, right? We just showed the NYSE McClellan oscillator. The summation index to identify that potential change in trend, and it's still straight up well above zero. So it's coming off some pretty low lows we haven't seen since 2022 there in October. Even that marked the bottom there in October. Boom, and we saw that rise up higher. So if this starts turning around, that could be the identification of a potential change in trend. The last time we actually had a correction was right over here, right? That 10% correction or so, that we identified the trend here, and it gave us some heads up notice. Doesn't mean that it has to identify the trend perfectly, because we could get whipsaws like so. But as long as you're aware that the change in trend is potentially changing, you don't need to fight it when we start to get those bigger moves. We talked about a lot on today's video. We went from a high level perspective of the markets, looking at kind of the macro view, where we kind of stand as far as the economy goes. Then we went to some yearly charts, and there's a big divergence between the two. Okay, so it's going to be, and then we're coming off of a very, almost a record type year over here in 2024, as we previously pointed out, and the Nasdaq 100 and the S&P 100. So it's likely to see an underperformance in 2023. That's what I would imagine, right? I don't think the Nasdaq 100 is going to get another 50% return. Whatever. If it does, you got to be prepared for it. Okay. And then we're in an environment where, the best predictor of a potential recession, is currently on. All right. So it's going to be a year of the stock picker, right? It's going to be a year to be careful and obviously manage risk. That's all I got for you on today's episode, everybody. It was a longer one, but I haven't been around, so I figured, why not? See you later.